streaming. Okay. Good morning. How is everybody today? Like we said yesterday, we're going to start on chapter 14 today, long-term liabilities. Of this chapter, I am only, the focus will be mostly on bonds. Okay, the bonds section of long-term liabilities. However, we will go over the slides very fast and very brief, but when we come to the bonds section, we will focus our attention and we concentrate more on that. All right, with that being said, let's go to the PowerPoint, chapter 14, long-term liabilities. Okay, Bailey, what's the difference between current liabilities and long-term liabilities?
Current liabilities that like gotta be paid within a year or less or whatever, how long that cycle is. And
Yes, sir.
long-term liabilities like over a year or more down the road, like mortgage or
Those are the liabilities that have to be paid within over
a year.
a year, yeah. All right. Okay. Long-term liabilities are debts and obligations that a company expects to satisfy in more than 1 year or beyond its normal operating cycle. Now, which financial statement has the liabilities? Is it the income statement or the balance sheet?
Balance sheet.
Yes, sir, it's the balance sheet. Let me jump over this slide. All right, the types of long-term liabilities. One of them, first one is bonds payable, notes payable, and mortgage. So what is a bonds payable? What's a bond? This is the most common type of long-term debt.
Only type of bond I know is like bail bonds and all that, but that's
This is like you could say it's like a loan. It's one way of financing or raising funds.
okay.
One way of, remember earlier, I think we said companies can raise funds or finance their operation through equity financing, like what we learned in chapter 13, or through debt equity, for example, the issuing bonds. Okay, so it involves a debt to many creditors. All right, any person who holds a bond certificate is a creditor to us. All right, if we are the company who is issuing. So we will learn bonds from the point of view of the issuer, not the point of view of the investor. All right, okay. And then you also have another type, notes payable. And like, remember earlier we said there is a current notes payable. They can come under current assets. I'm sorry, current liabilities, or you have a long-term note that comes under long-term liabilities. The difference is that it has, if it's a short-term note, then must be paid within a year or less, within a year of operating cycle, whichever is longer. If it's a long-term note, then it's payable within over a year. Yeah. Promissory note that represents a loan from a bank or other creditor. So the
It's like
note.
college, it's like college students when we have loans that we don't have to pay back until after we graduate.
Now, is there a contract? Did you have to sign a promissory note? If it's a promissory, if you sign the contract, then you have to pay within certain period and plus interest, then it's a loan. I mean, that's the note. Yeah.
Okay.
Yours may be a different kind of arrangements. The student loans, yeah. So if you took a loan from the bank, that's different.
Oh no.
Yeah. And then you have the mortgage, also another form of long-term debt. This is secured by real property, usually paid in equal monthly installments. Each payment includes interest on the debt and a reduction on the debt. That means, let's say you have a $100,000 mortgage on a house. All right. Every time you pay, your payment includes also interest, and it may include other premiums in it too. If you are buying a house, it may include insurance on the house also, plus the interest. And every time you make a payment, your balance goes down.
It takes a while to pay
Yeah.
off the house too.
Takes
It takes a while
20, 30 years.
to pay off a house.
Yeah. Are you familiar with that
Well,
payment? Do you live with your parents?
no, I stay down here by myself. But when I go back home, I stay with for like a couple of days. But other than that, I stay.
Who did you say?
I say, look, my parents are divorced.
Okay. I thought you said my wife.
No, I stay by myself.
Yeah. So you live by either one of them? You know, do you visit them?
Yeah.
Well, it's beyond this. But do you know if they have a mortgage?
No, they don't. They both stay in like apartments now.
Okay.
I mean, they had a house together, but then they split up. So.
Okay.
You
Okay. Other long-term obligation, you have leases, you have pensions, you have post-retirement benefits, you have deferred income tax. So in these things, I'll just mention the leases. That's when you lease a property or you lease something, and the lease can be a capital lease or operating lease. All right. When a lease has a term that corresponds closely to the life of the assets and thus is more like a purchase of an asset than a short-term lease, is called a capital lease. So if you, let's say you lease a machine, okay, a cleaning machine or something, and the life of that machine is, let's say 10 years, and you leased it for 8 years or 9 years, almost like you purchased this machine. So that's called a capital lease. Yeah. Okay. If it is you lease something for a couple of days or 3, that's an operating lease. Okay. Then you have pensions. Okay, those are it's like a retirement benefit where you contribute to, where the employer may contribute or your company contributes something to a retirement account. It arises from contracts that require a company to make payments to its employees have they retire.
It's like with police officers and all that, right?
Yeah. Well, not necessarily any company, if they have a pension, it's a liability on the company, not on you.
Oh yeah.
Yeah. So the company is obligated. But lately, you know, lots of companies are not putting anything in the leases. Yeah. I'm sorry, in the pensions. Yeah. Are you familiar? You know of any?
Yeah.
I was going to sneeze.
Oh.
It didn't go out. It's bad when you are about to sneeze and it doesn't come out. Yeah.
Yeah, that's cool.
Okay, and then other retirement benefits and deferred income tax. That the deferred income tax results from using different accounting methods to calculate income taxes on the income statement and income tax liability on the income tax return. This is considered a liability because these taxes will eventually have to be paid. So if it has to be paid later, then it is a deferred income tax. All right, you defer the payments to the future. Yeah. So here is a good definition of the bond. It's a security. Now remember financial instruments. Remember we talked about financial instruments or securities. Security is a financial instrument. Yeah. So security, usually long term, representing money that a corporation borrows from the investing public. All right. So let me go for a second and look for a bond certificate. Like what we did with the stock certificate, there's also bond certificates. So let's go online. Good morning, good morning. Let's go online and let's say go to Google. Google. And we look for bond certificate template. Bond certificate template. Oh, let me go back here for a second. Template. All right, so let's see if we can pick one of those free downloads. Let me go to this one, see. We need to have a big one. Let's see. All right, let's look at this one. Now, how can we make this bigger? That's certificate of achievement. That's not what I want. We want a bond certificate. Okay, let's see. Click on this one for a second. All right. And corporate bond certificate template. Can you see this one?
All I can see is your company name.
Huh?
All I can see is your company name.
Let's see.
Okay, so
Now it's a little bit larger.
yeah.
All right. It says here your company name, the company name, and man, can't we make this a little bit larger? Let's see one more time. All right, now that looks scary, doesn't it? Too big. All right, so this is to certify that, for example, you, the owner of a certain amount, fully paid and non-accessible, and on and on and on. Total authorized issued. Oh no, this is not. It's not a bond certificate. It looks like is a stock certificate.
Yeah, that's all.
I need a bond certificate. Again, here we go. Okay, this is template corporate certificate. We needed a bond certificate. Okay. Stock, corporate bond. Okay, corporate bond. It wouldn't make it larger. But anyway, it doesn't give us too much information. Corporate bond. Because this previous image. Bond certificate. Your company. Next. Stock. This is this is birth certificate. Stock. Bond certificate. Standard Oil Trust. But we can't see too much, correct? Standard. That's the last one. But you see how that looks like. This one is cancelled. And there are signatures on it. 100. Corporate bond. Can you see? It's empty. Nothing. Let me go back. Bond certificate. Images for bond certificate. Images. Okay. Let's see. Bond certificate. Here's a bond certificate. Can you see any? This is to certify that. So here is the name of the company. This is to certify that. I can't read it. Can you read anything from there? Huh? Well, anyway, you see how bond certificate look like. I mean, if you have one like this, that means you are a creditor. Okay? That means you lent your money to this company. You are entitled to get this money back plus interest, yeah. So let's go back to our. So it's a security, usually long term, representing money that a corporation borrows from the investor. A bond entails a promise to repay the amount borrowed, called the principal, on a specific date and pay interest at a specific rate at a specific time, usually semi-annually. It could be annually too, yeah, or semi-annually. When a public corporation decides to issue bond, it must receive approval from the SEC, Securities and Exchange Commission. The SEC reviews the corporation financial health and the specific terms of the bond indenture. What is the bond indenture?
I guess it's a contract that defines like
all the circumstances surrounding that loan, so or that bond. You can say the bond or the loan. All right. So, which is a contract that defines the rights, privileges, and limitations of the bondholders, including such things as maturity date, interest payment date, and the interest rate. Okay. Evidence of debt to the bondholder, the corporation, as evidence, the corporation provides each of them with a bond certificate. So everyone, if it's in multiples of 1,000, okay, that means you lend your 1,000 to them. company, and the company is supposed to return that money to you maybe within 5 years or 10 years, and also you know what the interest rate you're going to receive, and how often you will receive your interest. If it is every 6 months or every year, like that, yeah, okay? All right. Okay, here before we, let me also see if I can go to Word. Let me go to Word this time instead of Excel. Word. All right. So let's assume that Bailey's Corporation, B-A-I-L-E-Y,
Yes, sir. Yes, sir.
Bailey's Corporation. Okay, let's assume Bailey's Corporation wants to raise $100,000. Okay, wants to raise $100,000. All right, through issuing bonds. Okay, through issuing bonds. So the first thing that Mr. Bailey must do, number one, draw a bond indenture. Bond indenture. So you got to hire somebody, okay, to draw a contract. That bond indenture. Oh boy, I hope that indenture is with. Let me go back for a second. Do you see bond indenture here? Okay, there. Huh?
The previous slide.
In the, yes, okay, that we okay, yeah. Okay, this bond indenture is the contract about this bond, all right? So the indenture include in it all right, it includes in it the face value of the loan, amount of the loan. In this case, the amount of the loan is $100,000. Okay, $1,000, and the interest rate also. Interest rate. Let's say the interest rate is 8%.
Okay.
All right. Whoever gonna lend your money, you're gonna pay them 8%. And let's say interest payment every 6 months, semi-annual. That means every 6 months. And let's assume it is a 5-year bond. Five-year bond. So the question is, okay, what is, or let's see, how much does Mr. Bailey collect? How much cash? All right. Now, before we go, you got to get, like we said, once you draw the contract, you got to get permission from
The SEC.
SEC. So the SEC is going to look at Bailey's Corporation. They're going to look at this indenture in details, and then they may approve him or not. Once they approve him, then he is going to print those certificates, the one we saw a minute
In
ago.
order for a contract to be finalized, the SEC has to, the CEO has to approve it?
Yes, sir.
Okay.
SEC has to approve it. So between the time that Bailey decided to raise funds through issuing bonds and the time when he actually start selling those certificates, the interest rate in the market has changed. In the contract, it says he's going to pay 8% every 8%. All right, but how much he's going to collect for it? How much he's going to get? He's going to get what he is going to get based on the market interest rate. Okay, so I'm going to say it is based on. Say how much does Mr. Bailey collect? Will collect. Well, how much cash he's going to get? So it depends on the market interest rate. Depends on the market and okay. See, it depends on the market interest rate. Okay. If the market interest rate, let's assume if market interest rate is 10%. For such investment, for other businesses who are in the same line like Mr. Bailey, they are offering 10% to the investors. And Bailey is offering 8%. Yes, sir.
What's the normal interest rate? Is it 8%? It's kind of high though, right?
No, this is just assumption.
Okay.
Yeah.
Right.
Not the prevailing one. Not what is right now.
8% is high though, right? For an interest rate or?
For an investor at this time, yes.
Yeah, I thought so.
I'm just assuming here, so so we understand the concept. Yeah.
I got you.
Yeah. Just so for you as an investor, okay, Reverend Darian, for you as an investor, will you pick the 8% or the 10% as an investor?
When we
To
say
invest your money, would you like to get 8% or you would like to get 10% on your investment?
I'll get 10.
Yeah, you're gonna get the higher one, correct? It's simple. You're gonna get the 10%. So if people are going to invest with the 10%, they're not going to come to Mr. Bailey. So what does Mr. Bailey do?
Up his interest rate?
Huh?
Does he up his interest rate?
But that's his contract now says 8%.
He got to
File
step his game
for
up here.
bankruptcy and get rid of your bills and just start over.
No, you got to cut down on the price of the bond.
There you go. Step his game up.
But doesn't the guy have to sign up on that too if you make any changes?
No, but if he sell it with less than 100,000, he got to sell it with less than 100,000. So if let's say if the bond certificate is $1,000, all right, the face value is 1,000. So I mean, he would collect them in thousands. He would give you that certificate for 1,000, but you will give him less than 1,000, but you will get back 1,000. So that's an incentive for you.
I would get back 1,000. He would get less than 1,000.
Yes, sir. Because everybody's going to the other people for the 10%, but he has to cut down on the price so he can attract people to. It's just like demand and supply.
Mm-hmm.
When you lower the price, the demand will be higher. So you have to
Or-
cut down on the price.
I've seen in some cases where they lower the value and people just didn't want them no more.
That's when you call it quits.
Yeah.
And we just, that's what normal, we're talking about normal circumstances, yeah. So he cut down on the price of the bond. So you get back 1,000, you give him 800, you get back 1,000, plus you're going to get your 8% interest annually.
Oh, sounds good.
So that's how you attract. So he is going to collect less than 100,000. He was hoping to collect 100,000, but because he is offering less than the interest rate, less than the market interest rate, he's going to collect less than the face value. So he is going to issue the bonds at a discount. Yeah, he going to issue the bonds at a discount.
Not my company. I don't care. We're not gonna discount none of our bonds.
Then you can't get no money.
Nah,
You just found another buyer.
Yeah, we're gonna have some real people that's gonna look at them and come by, even though we're a little less interest, just cause it's me.
Every time you do a new contract, it's gonna take time. Sometimes it's gonna take a year between the time you decide and the time you actually start issuing the certificates.
Why so long though?
Because the lawyer
Okay.
fees,
Legal fees. Okay.
the lawyer, then they have to submit it to the SEC. God knows how long it's gonna take. Yeah.
Okay.
And then once you got to also announce it in the newspaper that it's going to be. So it takes time between the time you draw the contract, which is called the bond indenture, and the time to actually issue. Yeah. So it's up to you. You can quit the whole thing, and you're not going to collect money. But we talk about the ones who accept this choice.
Mm-hmm.
All right, they would do like that. So write down on your notes, if the market interest rate is higher than the stated interest rate, then the bond is issued at a discount. If the market interest rate is higher than the stated interest rate,
Yeah.
then the bond is issued at a discount. Then the bond is issued at discount. That means you're going to get less money than the face value
You should have what again?
at discount. Discount meaning that you're going to collect less than 100,000. Okay?
Because the value doesn't match, or this is like the what is the market? Yeah, is it because of the market or it's because of
Because of the market rate.
the market rate?
Yeah, it's going to collect, the market rate is higher, so he has to cut down. And vice versa. Now, if
The market rate is
the market rate is smaller than his, then everybody's going to flock to him, correct? So he will raise the price of the bond.
gotcha.
Yeah. So if, write down the second point, if the market interest rate is less than, if the market interest rate is less than the stated interest rate, then the bond is issued at a premium.
Premium. That's what.
Yeah. So if the market interest rate is smaller than the stated interest rate, then the bond is issued at premium. That means it's going to collect more than 100,000. Okay?
That what premium mean, or like what is premium?
Means he will collect or the value of the money he will collect or the cash he will collect more than the face value. That portion is the premium.
Okay.
So if he collects 110,000, then the 10,000 is the
It's a
premium. Yeah.
Gotcha.
And remember, it's still debt. Still debt. Even though he collects more, it's still debt.
State tax.
Yeah, still liability. Okay. So, so with this in mind, so let's see how much he's going to collect. The market rate is higher than his, so he's going to collect less than $100,000. So we got to learn, guys, the present value. We have to learn to do the present value in order to solve this issue. In order to find the issue price of the bond, we have to learn the concept of the present value. So this bond here that you see, okay, this bond that you see here, let's say today, this is today, and then this is the future. All right, the future is 5 years from now. 5 years from now. 5 years. 5 years, 100,000. That's how it works. So, how much he should collect today? Okay, so how much he should collect?
70,000, something like that? 80,000?
Huh?
70, 80,000?
How do you know that?
How do I know? I don't know.
We need to find the present value.
Yeah, but
First of all, we need to present. Okay, so we need. That means, guys, you have to go down, discount. You need to discount from 100,000 minus interest, minus interest, minus interest until you get to today's value. That's how you get it, yeah. So we need two present values. We need PV of the principal, okay, plus the PV of the interest. So we have two present values that we need to do. And once we do the exam in a minute, you will see what I'm talking about. Two present values. One for the principal, the $100,000, and one for the interest on the bond. Now the interest on the bond, the contractual interest. Okay? The contractual interest. So, the interest on this bond is going to be, how do we find the interest? Remember, I think in accounting one we wrote a formula for the interest.
Yeah, we did.
Is equal to the principal
Principal
times
the rate of
interest rate
times the length of the loan.
times,
The length of the loan.
which is in this case the interest rate, not the times the time, which is
5 years.
5 years.
no, usually it's an annual.
Oh.
In this case, it's semi-annual,
Oh, 6 months.
so it's going to be times
6 months.
8% times 6 over 12. 6 months out of 12.
Wait, so that's always like that?
It's always, yes, sir.
The 6?
Since this one is, it says semi-annual every 6 months. If it says annually, then you don't have to put times 6 over 12. It will be immediately 8 times 8%.
8 times what?
If it's annually, it's just the principal times 8%.
Oh, okay.
But since it's semi-annual, you guys will say times 6 over 12. So we're going to say 100,000.
Ali, hold on.
Yeah.
Wait, what do you?
So like the length of the loan, like if it's 6 months, then you do 6.
We're talking about annual interest rate, yeah. For 5 years, of course.
So,
Yeah,
Does
but-
that sound like if they was quarterly?
Now, now be careful here. Since we are doing periods of 6 months, so we're looking at how many periods?
2.
2 a year.
Yeah.
Altogether,
Yeah.
10.
10 periods. You're looking at 10 periods. It's 5-year bond, correct?
Mm-hmm.
Twice a year.
Oh, for sure.
Yes, sir. So it's 10 periods, sir. Okay, so we're going to be 100,000 times 8% times 6
I mean, it depends on the
over 12. All right, how much is that, Bailey?
Oh,
Come on, you are my assistant this for the numbers. 100,000 times 8% times 6 over 12.
You put your exponents.
times 6 divided by 12.
Mm-hmm.
4,000.
4,000? Okay. So every 6 months, if you look over here, every 6 months, Bailey has to pay
4,000.
4,000. Okay? So what is the present value of all of these payments?
What is it?
Because see, those also have interest on them, the 4,000, because it's a time. As time passes, there's interest in it. Yeah. So what is the value of these interest payments without interest in them? Interest, earning interest. So first, before we do that, let's do the present value of the 100,000. See, we need PV of the principal plus PV of the interest. So PV is what?
Present value.
Present value. Okay, so we need, let me put that between, make it bold. And
Present or prison?
Present.
Present. So it's present.
so we need two present values. Okay, present value of the 100,000
Mm-hmm.
plus the present value of the
Interest.
interest plus the present value of the interest. All right. So let's first do the present value of the principal. Now there are tables in here for the present values, and there is a formula also to find the present value. So if you look in the back of the book, this is the easy way. In the back of the book,
What page?
that's what. Okay, it's going to be towards the back when you see the tables. Okay. The tables start on page 1150. 1150. You see that? Table 1, what does table 1 says?
Present value of $1 to be received at the end of a given number of time period.
Yes, sir. So, for the principal, how many periods we have? For the principal, we have 10 periods, correct?
Mm-hmm.
And what is the interest rate?
8%.
Now, that's, see, you got to look at the market interest rate.
Oh, market. Okay, 10%.
Now, if it is semi-annual, then it's 5. So we're going to look at 5% and 10 periods. 5%,
I thought it was 10. The market's 5%.
yeah, 10, but then it's semi-annual, correct?
Oh, okay. So,
Yeah. It's semi-annual.
all right.
The interest payment is semi-annually. So 5 and 10, what's the factor?
That's 0.6.
614. So we're going to say, okay, the first one, PV of the principal is 100,000 times 0.614. 0.614. All right, how much is that?
$61,400.
400. 61,400. So, see, for the $100,000, see, it's in 5 years, it's 100,000. But today it is 61,400. Why?
The value.
Because the interest. See, the interest will earn interest. You will earn interest. So it will accumulate 200,000. So if you take the 61,400 plus interest, plus interest, plus interest for 5 years, you will get to $100,000. So whenever you ask issue bonds, let's say for 100,000, for $1 million, that's the future value. You got to find its value today. Okay, so the present value of the principal is 61,400. Okay, so this is the PV of principal.
Ali,
Yes, sir.
no air circulates up here?
Huh?
Does any air circulate up here?
Let me check. Somehow that doesn't work.
Alright, that's cool.
It's sit on less than 70, but
They probably trying to save money since ain't nobody really here, so.
Tripping. Rob me a little kid.
okay. Let's just finish this example then. So for the principal is 61,000, but we need to do it for
The interest.
the interest, which is 4,000. So we're going to say, okay, then we're going to go down. PV of interest is equal to 4,000 times. Now we need to find the factor for the, like what we did, factor for the principal. We have a factor for the interest. It's called annuity. Okay, this interest is called annuity because it's paid over several periods. It's called annuity. So there is a table for annuity here. It's going to be, look at table 2. Table 2. What does it say?
Present value of $1 received each period for a given number.
What's the difference between table 1 and table 2? Read the difference. Read the difference between the two.
There isn't.
Yes, there is.
You talking about the centers or you talking about numbers?
No, read what this one says and what that says. What's the difference between the two?
The table 2 says $1 received, and table 1 says $1 to be received.
No, what's it again?
Table 2 says present value of $1 received, and
To be received.
not present. I said table 2.
Okay.
Table 1 is to be received
Okay, to be received where? When?
at the end of a given number of times.
And this one?
To be received.
For each period.
For E. There is a difference between after a given number of periods
What's the difference though?
and after each period. There's a big difference. You tell me what's the difference between,
A given number of times.
say, this is 5 years, correct?
And then 1 says each time period, so after every time period. You get
See, this one is a 5 year, correct? The principal, you're going to get it back in 5 years.
Right.
But the interest is payable
every year.
every year. That's why it's called annuity. Yeah. So that's the difference between the two. One table for annuity, where the interest payment is done every period, as opposed to when the 100,000 is to be received at the end of, not every year, but one-time deal. See the difference?
The reason why I learned how annuity works because when people come up there to buy lottery tickets, instead they're like, well, instead of the cash option, they want to put annuity on it. So like, if they win, then they will receive payments for it.
See, if you win the ticket, you're not going to get the face value. You're going to get the present value
Right.
of the. That means you're going to take out of it interest for How many years? 3 years or 10 years?
10, I believe.
10 years. So you cut the interest from it, that's what's left for you. If you want your money at a lump sum now. But if you wanted annuity, you're going to get the whole amount of the ticket.
No, I think it's the other way around. Annuity, like it's with over time, right?
Yeah.
Yeah, that's what
So
I'm
you
saying.
divide the lottery, you divide if it's 3 million, you divide 3 million by 10 years or 20 years. You can do it that way, or you just get a lump sum, that means they
Get all of it.
take the interest out of it and you get what's left for you. Right? So the same, kind of a little bit like this. So look at table 2. Alright, the same thing. 5% and 10 periods. What's the factor? 7.722 times 7.722, and that's equal. How much is that? 30,000.
888.
All right, now add the two.
The 64,000 and the 30,000. Add those
61,400 plus 30.
two. Eight.
91.
92.
92.
288.
So let me put a line under this one. And here we're going to say 92. 288. See, he collected less than
100,000.
the 100,000. Why? Because the market rate is
10%.
higher than his. So he had to cut down on the price. By how much did he have to cut down?
2%.
7,712.
Huh?
7,712.
So he has to cut down $7,712 in order to sell his bond. Yeah,
That's crazy.
that's called discount. So the bond is issued at a discount. The amount of discount is
712.
712. Yeah. See,
7.
remember, we need the present value of the principal plus the present value of the interest. The present value of the principal is 100,000 times 0.614. Present value of interest is 4,000 times 7.77. Okay. There are formulas might be easier than. This is the easiest way to look on the tables. Yeah, but there are also formulas, mathematical formulas, to get the present value of the payment and the present value of the lump sum, which is the face value of the bond, 100,000 or whatever number it is. Okay? And you can do another example also if kind of switch it. If the market interest rate is 8 and his is 10, you're going to end up with over 100,000.
You'll get more.
Yes. So I think this is a good example and good practice. All right. So let's go back to the PowerPoint with this after this explanation. All right. I think we were on the next one. Yeah, on here. A bond issue is the total value of bond issued at one time. So price of a bond are stated in terms of percent. Okay, this is a different way. That is we just did that a little bit difficult way. Not difficult, but we use the present value. And another way is we must say his bond is issued at maybe 98% or at 101%. And then if it is done like that, you don't have to go look for tables, no nothing. If it's done at 97%, then immediately 100,000 times 0.97. If it is 102%, then we say 100,000 times 102%. Without going to tables and looking for that stuff, yeah. Okay, so prices, in this case, look at that. A bond is issued at 103.5%. Okay, 103.5 means 103.5%. Okay, means that 1,000 bond cost $1,035. See, so 1,000 times either 1.035 or 103.5%. Okay, so that's how much he is going to get for the 100. When a bond sells at exactly 100%, it means you're going to get exactly 100,000. Yeah. If the market rate equal the stated interest rate, then the face value of the bond is how much he's going to get. Yeah.
That's a rare. I mean, you gotta get lucky for that to happen. Like,
yes,
that stays the same over time.
Yes.
Like you said, it takes about a year.
It changes. Interest rate changes constantly.
So
the market rate.
It just so happens a year later, if it's still the same, or it comes back to the same as it was when you first sent it to the SEC, then that's be good.
Yeah. So if you don't want to do no calculations, we'll just say the bond issued at either 98% below the 100% or above the 100%. Okay. I think so what's the difference between the face interest rate and the market interest rate? Face interest is the contractual. That's what he is supposed to give the bondholders, the people who his creditors. He's supposed to give them. His was 8%. Okay, but the market interest rate was 10%. Yeah, we use the market rate in order to find the price of the bond, how much he's going to collect. But the face interest rate, that's the contractual that he's obligated to. Yeah, but when you do the tables, guys, you need to use the market interest rate, because we only use it to determine the price of the bond. Okay, so the market interest rate is used to find out the value of the bond, how much cash you're going to get. Yeah. All right. The market interest rate fluctuates daily. So, like we said, a discount when the market interest rate is more than a stated rate, and a premium when the market interest rate is less than the face interest rate. Like what we mentioned earlier, those are the ones that you wrote down. And if the two are equal, the market interest rate and face value interest rate, if they are equal, then you get the face value of the bond. Yeah, you get the $100,000. Okay, a couple of things. Maybe we'll just use this slide and then let me see how many slides we have left. 22. See, the rest is just the theoretical part, and we'll stop right here, and then I'm going to do the guys. Do you want me to give you the assignments in class for chapter 13? I'll give each you a copy, and the syllabus is on Jake's now, the correct one, yeah. But I'm going to print. If you give me a few minutes, I'll go and print syllabi and give each of you. Yeah. Remember, guys, you did not clear your.
Yeah, we gotta go. It should be there today.
What's the issue?
It's a process.
Huh?
It's just a process.
Ah, okay, yeah. Okay. So let me stop here, guys. I'll go and get you syllabi, and tomorrow, by the grace of God, I'll hand you the assignments. Huh?
Oh yeah, we got class tomorrow.
Oh no classes tomorrow.
See you on Thursday.
Thursday, yes sir.
I'll be out of town.
Thursday.
Yeah, I won't be back till like Sunday.
Okay. Does he? Can he give you a copy?
Yeah, I'm pretty sure you could. If you're gonna be here, you gonna be here, bro?
The syllabus is on Jix anyway.
Okay.
Yeah. But I'm going to get it now.
Okay.
The assignments I'm going to turn in the class, but also put it on Jix too.
Yes, sir.
Okay, let me stop streaming. Stop.